I'm Can Tavsanoglu. I'm the founder and chief investment officer of Caldera Real Estate Ventures. We partner with global family offices, ultra high net worth individuals, and alternative investment managers for their strategy creation and implementation and in external asset management, focused on real estate. I have a pretty good real estate panel today, so let's take advantage of having dedicated time from two successful colleagues here. I have right to me Vamsi Bonthala, who's the CEO and founder of Arbor Lodging Trust. And we have David Becker, who's head equity strategist and managing director of Time Equities, who's our gracious host today. So welcome, guys. We're going to talk about development, financing, investment, politics, micro and macro trends, projects, AIs, and other things. It's going to be an exciting panel. And we're going to talk about future of real estate. So let me just give the word to you guys, David and Vamsi. Please talk about your company. Maybe start, David, let's start with you. Talk about your company, your role in it. You've been there for a long time. How did it start and how's it going now?
Sure. First of all, thank you for Farhad and everyone else here for putting this on and having us. I'm happy to be here. Flew in from New York early this morning. So I'm David Becker, head equity strategist, managing director, and I'm on the executive committee at Time Equities. And we're a full-scale real estate investment development firm. Been around a long time, founded in the 1960s. We have about $7 billion in assets, 400 properties spread throughout the U.S. I think we're in 35 states, Canada, 6 countries in Western Europe, and Anguilla. I was there this weekend, which was nice. We have a marina project there. I started the real estate business in the mid-90s, but originally went to two-lane business, and then in New Orleans, and then went to Arthur Andersen, worked in their real estate consulting group for a couple of years, and then found my way over to Time Equities, looking for a more entrepreneurial environment. And yeah, we own everything from office to residential. We build residential. We built this building, and I'm sure we'll chat about it. I'm happy to have everyone here. This building came out great. We're really proud of it. To student housing, to retail, to industrial. So sort of everything but hotel.
It's a great handoff. Hey everyone, I'm Vamsi Bonthala, CEO of Arbor Lodging, based here in Chicago. For those of you not from here, the weather's like this every single day, so we never have any issues. But my business is all hotels, and really at our core, we're an owner and operator of hotels. On the ownership side, we partner with private equity, hedge funds, so mostly institutional capital, as well as family offices, both on a value add strategy as well as more yield-driven strategies. We really don't do new development. And then we also have a fairly large platform where we do third-party management too. We also have a credit arm where we do senior pref and mezz on hotels all in the US. And then an office in Mexico City in which we are growing our third-party hotel management business in Mexico and the Caribbean now as well. And next month, the business has been in business for 19 years. I started my career as a private equity attorney in New York, and sort of went through the typical trajectory of a lot of real estate guys where passed the hat around on that first deal and had partners at my law firm and clients and friends and family invest with us, and then started doing things with high net worths and family offices, and more recently, mostly with institutional capital.
That's great. Actually, I really like the curation of this panel because you do everything but hotels, and you do hotels only. So I kind of want to build up on that. David, maybe out of all the businesses you're in, let's just focus on your development business, because I think it's very different to what Vamsi is doing on a daily basis. You usually have a blank canvas that gives you the creativity, but also you need the vision, you need the staying power, you need the supplementing capital stack to make this vision happen. How do you navigate these challenges? And maybe talk specifically about how you did it in this building.
Yeah, primarily we're an investment company. I would say that typically what we do is look for value add, opportunistic, or generally income producing real estate investments, primarily in the US, but we do obviously look very opportunistically in Europe and Canada. But mostly we're looking for some sort of a discounted buy that we can accept income, grow income, be creative, renovate, reposition, lease up, whatever it might be. Development, obviously a very, very different business. Requires a lot more staying power, a lot more time, endurance, usually. And so we typically do 1 or 2 large projects every 1 or 2 or 3 years. This is a perfect example of that. We acquired this site about 10 years ago, and it originally was a smaller office property. We assembled land, parking, etc., and had planned out a high-rise condominium property. And as we were sort of approved and sort of looking for how we would create the capital stack, we ran into COVID, and also the financing for condos heading into that period was tricky, which was, I guess, 2019, 20. And we repositioned and pivoted to a rental strategy. So what this building is now is we went through a redesign, or a tweaked redesign, and made it a little bit more friendly for residential rental. And this building is 74 stories with about 700 plus apartments and I think 60 or 70,000 square feet of amenity space. And obviously you can see it came out phenomenally well, and it's a beautiful property with an unbelievable view, particularly on a day like today, so I'm glad we were able to catch the weather for a day like today. And this deal, we raised it very interestingly. We went, we have a large construction loan from Goldman, and then we raised a tranche of capital through a business that we have through the 1031 exchange space, and then our chairman and some principals and friends and family are in sort of the equity position, the natural equity position. So it was a creative approach to putting up a high-rise during sort of an interesting period of time. We're now up and close to 70% occupied, and the hope will be to finance it out when interest rates pull back a bit and the building is leased and stabilized, and then we'll hopefully be able to return some capital to our investors and own this property long term.
That's great. Fascinating building, for sure. Vamsi, you're at the other end of the spectrum. No blank canvas at all, but you're the preferred partner and operator for very established brands. That, to me, says rigid business plans, long list of requirements. How do you navigate that on a daily basis, and how do you bring creativity to that so you differentiate yourself?
Yeah, well, I think there's probably 2 different ways to think about that. So within the hotel business, there's obviously lots of different brands. Like Marriott has 39 brands now. Some of them are super rigid. So if you're taking like a Courtyard or a Fairfield, like you're going to have a pretty thick brand book that tells you what you can do on the physical space side. Then on the other side, as you go more up brand, and especially as you get into the soft brands like Autograph, Tribute, it's actually a pretty blank canvas. And that's a super fun part of the business as far as getting really thoughtful about design, food and beverage, just generally about operations. And I think that's really where we get to the creative part of this business, is that there's certainly a real estate component to it, but hotels are an operating business wrapped in real estate. When we are looking at deals, we approach them as though they are private equity deals for the most part. We're looking at what can we do to the operating business as far as from an expense standpoint, how to increase revenues. A lot of times that's restructuring operations, restructuring roles and people, as well as what we can do on the physical side as far as just making it a better value proposition and getting you guys to spend more money on rate. So, and in some cases it might be without a brand. So as an independent hotel, which personally we've been spending a lot more time on, sometimes those constraints that the brand is giving you about having to spend money on the asset is not perfectly aligned with the way we're thinking about how to generate value at an asset. And it's gotten to the point in some cases where, yes, you're giving away something by not having the brand's power behind you, but you have so much more flexibility as an independent that based on whatever basis you're at, you're going to have better returns.
And probably makes it a little bit more fun to work with.
Lots more fun.
And I think that's a good segue, this creativity that you're bringing, to my next question, because in my opinion, there is a big convergence between asset classes. This is office to hospitality, residential to hospitality, so different asset classes converging with hospitality. And I'm very used to buildings like this from New York and now in other markets. These buildings do have a hospitality flavor. What's your take on it, David, and how do you incorporate that into your design?
Well, I mean, so much thought, time, money, energy goes into the design of these major towers. In today's world, very hard to attract high-quality tenants without, the amenity space and doing things. This is obviously LEED certified, sustainability. So there's just so much that goes into it. But I would also tell you, they can be large traps also. This happens to be residential, it's a bit different, but I think there's going to be in these major towers, some real headwinds coming up, but particularly in office, which I think we're already seeing for a number of reasons. And so sometimes you can come in, and I would say this is probably a little bit more typical of us, is to think about basis and try and buy something opportunistic that we can survive if things downturn a bit, and then really thrive if we're able to see some good rent growth, maturity of the building, reposition, et cetera. But so much goes into these major properties that, for the most part, I would say, generally speaking, although this is a trophy asset, we really like stuff in different parts of the U.S. that are a little bit more manageable, a little bit more opportunistic from a pricing point of view, where you can really actually create value in a traditional sense. So many different legs. I know we were talking politically earlier, but think about how many different legs there are in getting a property like this up and running. From the materials to the labor to the financing, it's endless. But when you're done and it works, if you're still alive, you can do really well.
And it's such a lengthy investment horizon. It's not buying a building and creating a value-add business plan. Your business plan takes 5 years to realize, and anything can happen. What's your take on this convergence? For the blank canvas deals, do you think that people also want to feel at home when they travel rather than staying in a hotel room?
Yeah, absolutely. I mean, I think these guys are just copycats. That's what I think about these conversions. So there is certainly, I mean, when you walk into this lobby, it feels like you're in a hotel. Like, that has definitely been the case. And first, I think it started more on physical spaces. Like, this looks like something you'd see in a hotel, but I think some of these buildings now even do programming that you would see at hotels as far as happy hours and things like that. So
yeah, we have that. We have that here. It's great. Yeah,
exactly. So. But yes, I think on the flip side, you see the same thing. I mean, we're always trying to figure out how to create value and to protect downside. And so probably the best performing segment in the hotel industry, certainly for the last 5 years, and I'd probably argue even the last 15 years, has been the extended stay segment, which really can play hybrid. And by that, I mean like Residence Inn, Homewood Suites, the hotel rooms that have kitchenettes in them. And those really play such a great hybrid role of people that want to just have the extra space and are willing to pay up for that on like a transient basis on a single night. Or you can sell that to somebody for 90 days and effectively, they're not going to, they need an apartment, but they can't sign for a full lease. But if you break it down, what we're getting on a daily basis, it's kind of crazy relative to what it would be if you signed a 1 month lease. So it's kind of a win-win, right? And especially what we find on the economy extended stay basis is that we don't check credit, whereas landlords do. And so in some cases, a lot of time when people are transitional, if they're going through a divorce or they have to move or they got kicked out of a place, like they can stay at our extended stay hotels with a lot more ease.
There's a lot of legal compliance issue on that hybrid model, such as like in markets like New York. But I think that hybrid model works and can actually help the bottom line too.
Yeah, I mean, on the legal compliance, one of the tricks is actually that if somebody stays at length, by most laws in most states, it's treated as a resident, and so that individual then does not have to pay lodging tax or sales tax. But that is actually one of the things that a lot of states are trying to crack down on, and they're trying to get rid of that loophole for people.
Totally. I want to go back to you, David. You said that this is a trophy asset. Obviously, you don't get this trophy asset. You can't do this every year, maybe every 5 years, 7 years. You really like the other opportunities. We spend our morning really getting incredible insights about U.S. politics and national and international politics. But maybe let's talk about local politics that, in my opinion, that has been a longer trend that we all realize. How did that affect your view on opportunities, and how are you acting on those opportunities? What's next?
You know, I would say the primary question that I get is, how's the real estate business? Now, I see it from so many different areas because of how diversified our company is, and how many different kind of asset classes we're involved in, and other projects, and we have strategic partners all over the North American interface and Europe, and so I have like the pleasure of being able to see it from so many angles. The reality is the real estate business is very micro. It's not as macro as some might think. We share some of the main dynamics like interest rates, financings, and that I think goes across all real estate for the most part. But the reality is when you drill down, it's, well, what happened on a particular deal? What did you pay for it? What's the basis? What's the plan? Who's the tenant? And it's very micro. And as part of that, of course, micro politics, local politics, play a significant role. And it becomes a question of whether that city or state is a friendly place to invest. And typically what I find is that if it's friendly, there are outliers, then there are good business opportunities from a real estate point of view, because there's an encouragement of capital to enter the area and to spend money to make improvements in projects, in roads and things. Businesses want to be there. If you think about business, your tenants, if you think about from their perspective, they're thinking about the talent that they can get to work in those towns, in those areas. So there are certain places that attract talent, and then that and brings tenancy and occupancy to certain buildings. And then, of course, there's the reverse. So local politics can be very, very difficult. I would say it's very difficult here. It's very difficult in New York. There are other areas it's very difficult for obvious reasons. And then there are those that are actually encouraging you to come and make it friendly for business. So, you know, it's a range, and I would add probably population migration and where people are going. So those are some of the macro things that we think about, the local politics, but we think about them from a macro point of view and where people are going and where companies are headed, because it translates into real estate value. And I think that's like one of the key things that we're looking at these days.
Definitely, totally agree. How about you?
You know, our industry's a little different than like apartments or retail in that we don't chase demographics, because just because a certain market's growing a lot, our demand is coming from outside of that market. So it gets super micro to think about where it would make sense to be successful in a hotel. And there have been a couple of changes that I think have happened. I think when we were pre-COVID and we were in a regime of relatively controlled wages, interest rates were obviously low, and lots of other things were fairly stable, there was a reward for the pain to operate in like a California, for example. It was a high rate market. Yes, you had a lot more operational hoops you had to jump through with your team members, but it was worth it. I think now, what might be a surprise for hotel guys, because what's interesting about hotels is everyone has an opinion, because a lot of people stay at them. Not everyone uses a warehouse or industrial or whatever it is. rates have gone up a lot, but profitability has been pretty much flat in the hotel business. And that's obviously because of interest rates, insurance costs, and things like that. But I think that when you kind of think about that scenario and the pain of operating in certain markets, it has become less worth it. Now, the counter argument I would say is we've done a lot in supposedly friendly places like Phoenix and Texas and Utah. And there's things that are a pain everywhere. I mean, getting a liquor license in Utah is, as you can imagine, very difficult. And so, things like that are always going to pop up. Property taxes in Texas have been a mess recently. In Phoenix, they're so busy, you cannot get inspections done. Everything is delayed, which costs money. So I do think that everywhere there are things that you're always going to have to weigh. But I think for us also, given that it's not just the challenges of building it, but once it's built, then you have the operational part of it. We are definitely becoming a lot more sensitive to certain markets, and certainly union markets as well. For us, that's a really big deal.
Great points. Maybe let's talk about these current policy moves. David is in the business of longer leases, at least 12 months for residential, maybe longer for industrial. Offices even longer. But you're in the daily lease business, so maybe you do have an advantage. Do you see any immediate impacts of these, news?
Knock on wood, so far, not a lot. And I do think there's some qualifications to that. So we really only have one market that has kind of outsized federal government exposure, and that's in Kansas City. That's for those of you who don't know, that is a big federal market. We have seen cancellations there, and we have definitely seen pullback on that segment. But it's small enough, at least certainly in our hotel, that we've been able to backfill with other demand. And we are not in Orlando, we're not in Vegas, we're not in some of the more gateway markets that are maybe not necessarily being moved by tariffs, but have definitely seen cancellations from European and Canadian travelers. And that is real. I know people who have hotels in Orlando, and they have definitely seen impact from that there. So I think we operate in about 25 different markets, but again, not major gateway markets that have overexposure to international travel, that we have not seen a big move. But I'm getting weekly updates from our operations team, even if it's just anecdotal, to let us know what they're seeing, because in our experience between the great financial crisis and COVID, things move really fast, especially for hotels. Now, we also come back the fastest, and we generally come back the strongest just because we're setting daily rates. But when we are seeing weakness, we start to see it pretty immediately.
Great points. David, any speculative thoughts on what could happen? Probably a game theory question for you.
Well, I'll give you a couple different metrics to think about a little differently. The tariff thing it's hard, it's too early. You don't really know yet, and I think we covered that earlier. But it's not as if there weren't tectonic things happening in the real estate business before that. Let me just give you a couple. Remote office. A complete destruction of office value. Destruction of office value throughout the country. So a little bit bifurcated in the sense that Class A buildings in the A location of whatever city is done much better. And then I think suburban, second, third tier cities with buildings that were built 25, 30, 40, 50 years ago that are in need of repair and tenants, deep trouble. The banks, the regional banks, holding loans, deep trouble on those loans. So in my personal opinion, there's so much out there that has not been marked to market yet in that particular sector. So it's not like there wasn't pain. It's just that in real estate, unlike the stock market, so I have a lot of stock market hedge fund friends, it's so immediate. Usually the stock market will over-penalize very quickly and then over-reward quickly. And it's this very big pendulum of over-penalizing and over-rewarding in those volatile moments. Real estate, for better or worse, is much slower. It's like a slow upward trend or a slow bleed. And it typically is property specific, tenant specific, and something that relates to like that particular situation. Whether a particular sponsor has staying power, doesn't, needs capital, doesn't, et cetera. So the tariff thing hasn't really fully played through yet. And as I mentioned earlier, we're seeing in our industrial properties some leasing activity. It could be short term because some people are panicking and grabbing extra storage and goods to get it here and store it. But in general, it's pretty healthy. So like that's one segment of the market right now. We can talk about that a little bit later in terms of what my favorite asset class would be. If you think about interest rates, we just got so hung up on the 2% money that the shock to the system of going to 4 and 4.5 feels like an unbelievable surge, and it was from there. But if you look at a 25-year average of the 10-year, we're right there. We're basically at the 25-year average marker. I started underwriting deals late 90s, 6% money to get debt. Cap rates were a little higher. So, does that mean it's here longer? So those are the kinds of things that I think people are thinking about or need to be thinking about.
Yeah, I agree. Great comments. Actually, talking about tectonic shifts, maybe let's talk about AI. I think we have to talk about AI. And everybody, it's a loosely used term, in my opinion. I think AI, in my opinion, based on my readings, is very good at large data analysis and maybe recognizing patterns. What is your perception of AI? What are some use cases for your business?
Yeah, I think a lot of people that spend a lot of time on AI, I think travel is probably going to be one of the most impacted industries by it, and it can be a variety of ways. Because we're so consumer focused and consumer facing on all the decision making. If you just think about your own decision making of when you plan your own trip, it's hard to really imagine what the role of a travel agent is in a few years when you can basically have your full conversation with your own chatbot to put your complete itinerary together. I'm already using ChatGPT to do it that way. But I think what's probably the more existential issue that our industry talks about a lot is if you think about what the value of brands are, and this probably applies to all consumer goods. So right now, the number one purchaser of AdWords on Google is the travel industry. So it's Hilton, it's Marriott, it's Expedia, it's Booking.com. And so you are being manipulated when you search, hey, I want to go to New York, where should I stay? It's the purchasing that's happening behind the scenes that's telling you what hotel to stay at. But that is all because it's based on spend. And when you start using AI to do your searches, it does not get manipulated in that same way. It works off of what your likes and dislikes are and how you've taught it. So if you've gone on 10 trips, you planned them in ChatGPT or whatever it is, you tell it what you liked about the trip, what you didn't, what you liked about the hotel, what you didn't, and hey, now I'm about to go to Paris, plan my trip out for me. It can go much deeper in its search to tell you where to stay. And I think that really now becomes, in our industry, we pay a royalty fee to these brands because they produce a lot of reservations for us. Like, it is worth it. But at some point in the future, you do start to wonder what is the value of that if you can bypass that whole process, because you're not getting that consortium, no pun intended, but consortium pricing that comes with that anymore. So I do think that is, that's just like, the tip of a lot of what is, like, our industry is going to change pretty dramatically off of that.
David? Yeah,
AI, I mean, is there anything more discussed in the world today than AI?
I'm obligated to ask AI questions.
I wish I knew. I try and think about it in the context of how we can be more efficient in our properties. We own 400 properties, a lot of different tenants. We have a large investor base of so I think about software and things like that, and efficiency and ways to maybe enhance our businesses. But it also could mean a lot less employees at certain facilities, if you think logistics and whatnot. But I think it's going to have a major impact. I think it's going to really well, let me give you one thought that right now, to me, it's about where the power is. So I don't know if the technology will catch up where we figure out power a little bit better. I think about our infrastructure, things like that. So I think there's going to be a lot of centers of influence that aren't necessarily the centers of influence today, but if you were to look out 10 years, 15 years, that might change based on where the power is and the accessibility of the power. So that's just my own thinking because it requires so much power. But it's going to have a huge impact across industry and asset class wide. I don't really know if it's going to, I'd say it's going to be efficient for everyone and it's not going to spare anyone. And I think it's just important to stay in front of it as best as you can. I mean, at our company, even our tech people, unless you're a true AI forward-thinking person and have specialized in it, it's hard. So I've suggested that we go get a few AI liaisons to consult with us, to actually look at our business and be a consultant to our specific business, and just how can we use it efficiently, both for the employees and make life better and easier to go to work, and then also our various properties and tenants. And again, it goes back to amenities to the extent that we can offer it in a favorable way.
And I completely agree with the fundamental future analysis of asset classes, looking at these trends like power needs and data center needs. I know we have 10 more minutes. Let me continue with one last question that is also relating to another, I think, favorable topic, risk management topic, climate change, right? That I think impacts real estate directly. So a statistic from our ESG white paper from last year. In 2023, U.S. experienced about 28 natural disasters that each cost more than $1 billion, totaling $92 billion in losses that year. 2024 was not better. What does that make you think in terms of operational challenges and new investment opportunities?
Well, I think in the near term, we've been talking about, obviously, climate change for a while and the impact it could have. I would say in the last 2 years, we have now arrived at that impact on insurance costs, certainly in Florida, but I think it's now all across the country. You're seeing a lot more pass through on expenses from insurance companies, regardless of the asset class, everywhere. And so that is definitely becoming something that we all have to be a lot more cognizant about as we value things and price things. And then I think it really also just depends on your time horizon. It's pretty amazing to me that the most sophisticated, largest investors, sovereign wealth funds, private equity funds, with all the data they have, are still investing so heavily in Florida and California and coastal markets where everything they read and everything they know and all the experts that come into their investment committees tell them there is risk, but it doesn't match with their timeline. But I do think that higher net worth families who are thinking on multi-generational and longer term, I have definitely seen more of a flip of where they are thinking about places like the Great Lakes and the Midwest where there is more climate resiliency. And I think there's a lot of new data and a lot of new software services that are being able to help map out this for you that that just helps you. It kind of just depends on if you think you can get out in time, there's still a lot of money to be made in some of those markets. But I think on a medium-term, longer-term basis, how can you not think about where places are going to be more resilient?
Totally. I was going to make a joke and say, is it real? But I thought it would not go over well. And I was kidding, of course. It was a joke. Tough crowd. So obviously it's a huge issue. It's huge. It has spread, I agree, like across every asset class. Florida, there's certain parts of California, they're like uninsurable, down to the homeowner. Forget about the commercial landlord. Like a company like ours, we've umbrella policy covers all of our properties, but you're fighting with the insurance companies, even to just determine the premium allocations. The deductibles have doubled, which is very, very significant. So I agree that I think there's interior cities in the U.S. that are going to benefit from it. Like, just give you an example, is Nashville. You could say Austin. So there's places that, maybe Charlotte, North Carolina, potentially. Like, there are certain places I think that will benefit naturally because they're a little less susceptible to it. But I don't know that anyone's, it's everywhere. So I think something has to be done really at the legislative level. And then I think builders need to be smart about where they rebuild properly. I went to school in New Orleans, and I love that town. That's one of my core cities that I love. And but there's certain areas of that city that are underwater. So hurricane rolls in, destroys it. Why are we rebuilding there? It's just, it's not really, if we think about things over a 10, 25, 30-year horizon. So I think some thought has to go into where the rebuilds are.
Yeah, really.
John, I had a comment on that and kind of a question to the panel, because when we really talk about climate change and climate resiliency, and we talk about damage from the insurances, we're talking about hurricane damage. But the real damage is the damage we've not really yet seen yet, and that's rising sea levels, right? So when we look at places like Miami, even New York, where David and I both live, in John, I mean, those sea levels are a real thing, and they don't need to be. The rising sea levels doesn't need to be very high to absolutely overwhelm a city. Like right now, when you look at Miami is built on limestone. It's absolutely saturated like a sponge. So you're talking like 1 or 2 more inches of sea level, and now you have a completely different built environment in Miami. So if you're investing today, now you're not going to see the real impact of that probably for another 20, 30 years, right? But if you're buying real estate today and you have a 10-year horizon, 10 years you're buying to that next guy who's buying for 20 years. And so like, are you underwriting that risk correctly or properly, in these markets? Especially when insurance companies are looking at the data and they're looking at this and saying, we're not going to insure, we're going to insure at such a high rate, the banks are going to stop lending without the insurance and can't issue mortgages. So like, how do you guys sort of think about that whole cycle? Because I feel like that's a really underappreciated, under-discussed point, but it is a reality.
I totally agree, and I feel like we really don't quantify that much. The insurance companies are doing it, and I'm told maybe the California, government subsidized insurance plan, because private insurance companies stopped, I think, insurance people a long time ago, so they had to insure their own people. But with these recent losses, maybe that goes under. So I don't know what the solution is for people who don't get insurance. We work with very different clients in very complex projects. I think those complex projects have so many, different variables right now that we have to think about. Even the lenders are not really pushing us to think about these things. So I'm not really seeing a systematic approach to this at all. So we should probably be in the forefront of it and push for it. New York infrastructure is obviously it's in a really bad shape. I think we have a few minutes for questions. Such an enjoyable conversation. So good to hear from really active and successful investors like yours, like you guys. So I'll just open it for some questions from the audience. David.
So this building, what did you project your cap rate going in for this was versus what you projected your takeout loan interest rate to be?
Well, we didn't. I get, typically a trophy asset, like, keep in mind, we built it. So we like to think that we built it for, and again, trophy is different. Like, this high rise is very different, but we probably built it in the 6-ish range.
Inclusive of land, like everything?
Yeah, well, in mid 6s, I think, is probably a fair number, which I think that's probably where we landed, mid-6s. We probably aimed for a 7, but time, capital, costs. Although we did have a very, very good contractor here and had a locked-in fixed price. The exit, you tell me. I mean, there was a time where a building like this would sell for a sub-4 to some sovereign fund or something like that. We were more interested in like building it to a point where we could finance it and own it in a stable way, again, because we're longer-term holders. So we were comfortable in that 6-ish range. We built something in West Palm in the same 6-ish range, and not a high-rise, but a couple hundred unit complex in West Palm in a growing area. And we were sort of with the same mentality, but now it's gold, meaning like, where the rents have gone. So sometimes it's just about the rent growth on what's happening. So down there, rents grew crazy. I think we're good here, but we don't really have any exit plan. But I would think this would sell for somewhere between a 5 and a 6 today.
I guess what was the borrowing cost? What do you anticipate the borrowing cost to be on a refinance?
When we exit, 5 and a quarter, 5 and a half.
So you're shooting for like a 1.25 spread is the
On arbitrage.
Yeah.
So if we wind up with a stable core, this is a core asset. So we typically won't finance negative leverage. Or arbitrage.
I see a lot of ground up stuff getting greenlit that, everyone can with a pro forma make something seem amazing, but when you look at negative leverage, I don't know how it works. A lot of people do it.
We would rather own it cash.
Yeah.
We're just not a negative leverage player. That's death.
Yeah.
There's no way out of negative leverage unless, you're in some very short window where the value's there and you're creating the value in your short term.
So definitely in this environment, there's no catalyst that tells you there's going to be such amazing growth that you're going to grow out of that negative leverage.
Yeah. And on a debt standpoint, I don't personally think we're going back. So I think we underwrite sensitivity always. We buy a lot of deals with cash, and we're not really ones. I don't really think we're headed back towards 4.25 rates all in IO for 10 years.
Agreed.
So the office, Chicago, it's almost a disaster now, 30%, sort of vacancy factor and growing, and, private credit and lenders are sort of taking back. So I don't hear about it very often, and you sort of mentioned it a little bit in your discussion that, it's a problem. So when does that shift? When does the shoe drop there? It's like, when does it start to get absorbed into our daily conversation? Or are all the things they're doing converting like New York, I know they're doing a lot of converting it back to residential. There's been a little bit of creativity here now in Chicago. So when does that sort of happen? Or does it not happen?
I think it's actually kind of started. I think there was nothing happening, but about 12 months ago, you did start to see banks finally starting to sell things at massive discounts or assets start to get handed back and things like that. But it's been very orderly. And I think that's more of a measure of just how healthy banks are. If you think back to GFC, the FDIC was making all the decisions and pushing these massive moves, and the market was just getting flooded with distressed assets. We're not seeing anything like that right now because while assets are distressed, the banking system isn't. And so I would say almost weekly, I am certainly in Chicago, but nationally, we do see assets, mostly office, but other asset classes as well that are slowly kind of hitting the market, but it's definitely not been a flood because we're pretty active on the credit side and, on our warehouse lines and our A notes, we work a lot with banks and they're definitely not feeling pressure that they've got to get all this figured out.
It's not easy to convert office to residential. It's not, it's particularly if it wasn't built in a modern strategy, it's just hard. It costs more. Sometimes to a point where, it doesn't work. So it's...
But we're converting a hotel to apartments. And that's been more complicated than we thought. And there's bathrooms in every unit already there. So office is off the charts on how complicated it is.
Got it. So it's more of an opportunist play now? Is that sort of where we should be looking? That it will orderly come back and then the banks will release it back into circulation? Or...
Yeah, I think like anything, prices have to clear, And then, look, there's also like a lot of things not being built now that might have been built, so that helps. But it's hard to have unless you're, again, it's all about basis. It's very hard to have a very favorable outlook on office at this current moment.
Well, I was going to say, if you look at the TREP data, which tracks CMBS loans, you'll see the 25 maturities are 2 to 3 times higher than 26 and 27. Well, that's not because they're 25 maturities, that's because they were extended from 23 and 24. And they can only extend and pretend for so long. And so now you're seeing banks and CMBS lenders forcing asset owners to disgorge assets because they're not going to extend anymore. They're done. And so they're just saying, sell it. If we have to take a write down, we will, but we're done.
And we did see that in 07 and 08. I mean, basically, listen, I was in college, but I'm a student of the game. So in 1989, the FDIC came in and said, sell everything. You know, banks can't own the real estate. Flooded the market. Prices went down 90%. In 2007, with TARP and everything, they basically told the banks to hold, more or less. So it eked its way out over that 3-year period. And so there was great buys in 08, 9, 10, 11 even. And then you've seen a run since then. So I guess that's sort of what you're getting at, that they're not out yet, really, just one by one.
I mean, I haven't seen this sort of scenario. I mean, it was more organized in 08, 09. I started my career, I was an advisor of the RTC. That was my first assignment.
There you go.
At Solomon Brothers. And it was the same, and I haven't seen what we're seeing now, at least for office and hotel. Multifamily and industrial, I think, are fairly priced.
Yeah.
I don't think they're discounted at all. I don't think they're premium pricing either. But office and hotel, it's what we're seeing. Like the last time I saw this was the RTC days. And we used to talk about 12 cap deals in 1991 when I started. That was a 12 cap. That's what you bought things at. And 12 cap eventually got to 4 cap, and now it's going back out. We're seeing hotel and office deals at anywhere from 8 to 12, going in yields.
And we're questioning it there.
Yeah. Yeah.
Okay, I think this is our time. I really appreciate the insightful comments. This was a very enjoyable conversation, and we'll continue.
Thank you, gentlemen. Thank you. Thank you all.
Thank you very much.
Good job.